Right. Good morning, everyone, and welcome to today's Bridging and Commercial Virtual Roundtable, organized in partnership with Together. My name is Andrea Dulguero. I am Media Publishing's Deputy Editor for Print, and it is my pleasure to host and moderate today's discussion on what's in store for the bridging and commercial finance markets. As you all know, specialist finance is an ever-changing sector, and this has been especially true over the past 12 to 18 months, which has seen this market impacted by several macroeconomic challenges, including falling house prices, rising Bank of England interest rates, and fluctuating inflation figures. While it is very hard to predict exactly what will happen in our sector, especially without the help of a magic crystal ball, everyone understands the importance of analyzing how the market has performed so far and identifying trends that might emerge in the coming months, which is exactly what we will be doing during this roundtable with the help of our esteemed panelists, to whom I would like to give the floor now to introduce themselves.
Do you want one of us just to start?
Well, you guys seem to be a bit shy, so go ahead,
I don't
Emma.
like silence, so I'll go for it. So I'm Emma Ross from Ross Commercial Finance, and I'm a broker specialising in mostly commercial stuff. So that's anything from your bridging, development, commercial mortgages, quirky residential, invoice finance, asset finance, unsecured lending, business growth, all that sort of stuff. Finance all over the UK. I'm based in Glasgow, which you'll probably tell by my voice, and do a lot in Northern Ireland as well, but can fund all over the UK. And minimum borrowing I work from is like 25,000 right the way up to no maximum really. Over 250 lenders on the panel. And yeah, that's just a wee bit about me.
Perfect.
Okay. Hi, Andy Keehner at Finance. I'm heading up, there's a group of companies under the Finance banner. I'm heading up the Finanze Strategy arm, which is the bridging and commercial brokerage. We do have a lending arm, a buy-to-let and commercial term arm as well under the banner. The key USPs for the lending arm, which we have, are title split products and below market value purchases, which seem to have a large uptake at the minute.
Michelle, you want to go next?
Yeah, I was just about to go. Hi, everyone. Good morning. Michelle Walsh. I'm head of intermediary sales at Together Commercial Finance. So Cara, who's with us today, is a member of my team. I've been in the finance industry over 20 years now, but in property for the past 18 years. Initially, a good chunk of my career has been in high street lending. However, the last 7 years, I've been working with specialist lenders. So I've got experience across the range of products, and here at Together, we've got an array of products to pretty much suit the majority of property purchase transactions, from your second charge, first charge, buy-to-lets, commercial, residential, bridging. You name it, we've probably got a solution for it. So I'm really pleased to be joining you all this morning.
Perfect. I'll follow in from you, Michelle. Thanks for joining, everyone. I'm Cara Williams at Together. I'm the intermediary relationship manager. That's a bit of a tongue-full, isn't it? In the north. I'm based in Manchester in the northwest. I've been at Together 10 years now, so I've probably come across all sorts of weird and wonderful solutions and scenarios that we provide clients. I deal with everything regulated and unregulated, from commercial, bridging, buy-to-let to your regulated bridging, residential, second charges. That's me. Thank you.
Perfect. And Natalie?
Best till last. So I am Natalie Glover. I work at SPF Private Clients. I have only been here for nearly 2 years now, but I have been a broker for 11 years, nearly 12 years. So I concentrate mainly, like you guys, in the commercial sector. I'm officially on the bridging team at SPF, but I do everything real estate debt advisory essentially. So whether that's bridging, commercial development. We've got quite keen interest in development. So yes, I'm very happy to be on this. Thank you very much.
Perfect. Thank you very much, all. Just before we start, I would like to remind our lovely audience that they can ask our panelists any questions during the roundtable, and these will be answered during the Q&A portion of the event, which will be around like 11:45. There will also be poll questions throughout the conversations, so we definitely encourage everyone to participate. Speaking of, I will put up the first poll question, and we can kick off the discussion. I think the best place to start off is to look at how the commercial property market has performed over the past 12 months. From your experience, which asset types have performed the best and which ones have performed the worst?
In my personal opinion, I think industrial is definitely the one where I see the biggest kind of requests for. I think it's like where I'm based in Glasgow, there does seem to be such a lack of space as well. And I think from a commercial investment point of view, it's something that I get asked a lot about, even from people wanting to know anyone I know that's got space, etc. available, even to the extent that some people buying farms just to get the land to try and like cement the ground to have like storage for like haulage companies and things like that. So yeah, I would say industrial the biggest that performance wise, and I would say that hospitality is probably it's still a request I get a lot, but the lenders are least interested in it in my experience, just because the whole cost of living crisis, it is a bit of a, if people really need to cut back on their money, are they going to spend going to the pub, or are they going to pay their electricity bills? So that's just what I can see from my side.
Yeah, I definitely agree with that, because obviously with offices and things, everyone has, since COVID, I think most of the workforce has been encouraged to come back into the office, but actually the reality is we've kind of proved that we can work from home. So a lot of people are still very much hybrid. They don't need the massive office spaces anymore. So that's always a bit of a touchy area. Whereas obviously industrial, people are still manufacturing things. There still needs to be space for like haulage companies and deliveries and things like that, with the internet shopping going mental. So yeah, I agree with Emma. I think industrial.
Yeah, I can add to that. It's warehousing in particular that has obviously seen a boom coming out of COVID. Retail took a massive hit, but it seems to have bottomed out. Now, retail did start to come back a little bit last year, but the interest rates have just leveled all of that out a little bit and caused a bit of an issue. Offices has obviously taken a wobble as well. With office space, you have the Tuesday, Wednesday and Thursday crew, or the flats as we call them down here. And yeah, there is still a race for space though. And the race for space in particular is still buoying the warehousing and the industrial side. But the industrial side, you have to be a little bit careful, because a lot of places overbought the space during COVID. So there is actually some industries out there that have more space than they actually require now that this has dropped down. So there is a bit of a balancing act, but I think the lack of space will always mean that everything will go in the right direction.
Yeah, I would agree with you that on the respect of the race for space. And I was reading an article, particularly on offices and primary and secondary offices. I think the biggest office, the bigger offices, we've definitely seen a decrease in kind of like inquiries on that side for the for your bigger banks, etc., with more people since COVID working from home. But I think your secondary offices with smaller businesses, I think more people that are local have free parking because of the cost of living, because of heating bills, are now going back to work in the offices. And I think we'll see an increase in sort of the race for space and sort of people going back to offices as well.
Yeah, Completely agree with every comment that's been said thus far. And I think there's certainly going to be a continued or a growing opportunity for prime office accommodation. So when I say prime, that's location, but also quality. So, you know, energy efficient office accommodation that makes operational sense as well to run that business, to keep costs low. Also great for the environment. In addition to that, I think wider opportunities that we've got as we go throughout 2024 is student housing. There continues to be a growing need. We're certainly seeing a lot of it together for student housing. And I think there is some viability actually with cooling inflation and good rental growth, that development schemes are likely to be more viable throughout 2024. Of course, we need some loosening of that red tape when it comes to planning to be able to convert, say, some of these larger non-prime office accommodation into residential and address the shortages that we've got with labour and the skill sets that's required in the building industry. But I think we certainly will see an opportunity there for residential development. But yeah, retail, we are starting to see an uptake in retail.
It's really interesting. Just looking at the poll answers from the audience, it seems everybody agrees with the industrial side. There seems to be a lot of demand for that. And interestingly enough, people are seeing there's quite a balanced number of answers in terms of like all types of commercial property. So that's encouraging to see. In terms of the UK regions where you've seen activity so far, are there any regions in particular that have seen a boost in commercial lending activity over the past 12 months?
I think Greater London always tends to stand up well and continue to be resilient. In fact, I was reading some research a few weeks ago, and just over 80% of all investment of commercial investment occurred in Greater London last year, which is well above the average of the last 5 years of 52% there. So investors do continue to target high quality offices and prime locations, which kind of reflects that demand, the growing demand within the London region, including student accommodation as well. I guess from a area that perhaps might have struggled, you might correct me on this one, Emma, but I have read some I guess analysis from Knight Frank that revealed that Scottish commercial property investment volumes kind of fell to 1.5 billion in the challenging year that was 2023, and it was the lowest level in the past 5 years as the market is adjusting to interest rates. So I think there will be challenges perhaps in some of those smaller regions. I read, we've done some of our own analysis together on the commercial opportunities. Cardiff is another region that's actually facing some struggle in the area, but you know there's plenty of opportunity out there. But certainly prime locations where you've got the city locations with students, and as I say, prime office accommodation is certainly going to continue to perform well moving in 24.
Yeah, allegedly a lot of foreign investment is buoying the London market, the commercial London market at the minute. And I think that might be skewing those figures a little bit because the amount of US money that's coming in. I mean, the Northwest is in particular industrial areas around the surrounding areas of Manchester. You know, it's absolutely mad up there, the amount of development that's going on for commercial. And yeah, I mean, I would err a caution with student accommodation that's been mentioned, because certain areas may be hit with this, because there is rumours that universities may start to struggle a little bit, and you might find some closing of certain universities out there because again the lack of funding that's going on there, and this will obviously hit all of those purpose-built student accommodations around. So I don't know what particular areas that's going to affect, but there is a little bit of a pullback on PDSA stuff, so it's worth bearing that in mind in terms of areas.
Yeah, I would say that like with the commercial side, so thinking of like Scotland in general, I would say I'm doing a lot of commercial to residential developments, particularly for students. So like up in Andrews or near Edinburgh Uni, Stirling, all the kind of bigger unis, and it is a lot of foreign investors. So it's a lot of maybe developers here in Scotland, but they've already got like pre-sales or pre-lets because it might be somebody from Hong Kong that's sending like 10 students at a time over, and it's like guaranteed leases, which is great. But I would say I'm seeing way more of like kind of empty units being purchased for development to resi rather than staying as investment. Probably more last year with the office space to residential, whereas this, what I've seen so far over the last like 4 months, is a lot of people are actually getting the commercial offices, and I think automatically, oh, they're going to want to turn this into residential, and they're not. They're actually wanting to turn it into the more quirkier like residential offices we're talking about, Michelle. That's got like the gym on site. They have like networking events once a month, and it's more of a kind of a social place with wee spaces for people to go and hang out rather than proper old school serviced offices type thing. So I can see that picking up a bit more as well, but I do think the commercial to resi development is massive as well.
Yeah, I would definitely agree on the commercial to residential with you all on that. I definitely think, particularly the past couple of weeks, sort of the inquiries that we're seeing at together as well are picking up on the commercial to residential side, particularly with your foreign investors and your more sort of, your high risk nationals as well. I think that's something sort of for the future that will be on the increase.
Yeah, creating smaller spaces as well is quite key in the commercial market. I've seen quite a few rent-to-rent schemes out there where taking a large commercial building, getting it on a decent lease, and then carving it all up into smaller boutique areas that they're renting out, and they're creating more of a working space environment with shops and cafes and things like that, where you'd want to go and work basically in a larger community, a bit like the WeWork model. But yeah, I've come across quite a few of those last year in particular.
Yeah, it's like Emma said, isn't it? It's creating that network sort of social environment that's appealing to people.
Yeah,
absolutely.
I've seen maybe one or two of those, I suppose, but and I don't know whether it's obviously because I'm based in the city office in London, that I am seeing mainly kind of London commercial things. Actually, retail has started to pick up a lot, and things like restaurants, which I didn't really expect, to be honest, but maybe it's because it's London. I don't really know. But yeah, I have seen that where they're kind of splitting up the office, or what was one office or one retail, and it's split up into 5 for the smaller businesses to kind of go in and rent from there. And I suppose they probably get a premium on the rental because everyone's willing to pay a little bit more for just a bit of space rather than committing themselves to the whole hog.
That on the back of that, so what I'm even seeing in the industrial side is, in fact, over the last 2 weeks, even like 3 clients have been seen where they've maybe had they're looking to like move premises, but they want to buy one big massive unit, turn it into 4 units. They're going to trade from, let's say, 40% rent, the other 60% out, but the rental income they can get from the other 60% will be used to pay the mortgage, and they're basically in their rent free as such. But splitting that building up into 4, 5, 6 different segments is more like people want to be around other people that are in the same kind of like industry. So for these guys, they'll have like, maybe if it's a construction, they might have like painters in one part, joiners in the other, but then they can all work together, and it's referrals between them all and things. So it's really popular just now as well.
I think we've definitely, oh sorry.
No, go ahead.
I think we've definitely seen an increase on that, particularly since COVID, when everybody had to work from home. Like you say, people are now starting to get back out there more, aren't they? If you put businesses that are similar businesses next to each other, it's about that networking and that social kind of environment of people actually getting back out there and getting back into rented space.
Mhm. It's really interesting to see the types of projects that people are taking on and types of commercial deals that are starting to pick up now that market confidence seems to come back, which brings us to how exactly like what are the most important factors when considering which commercial deals to fund as a lender. And I actually want to bring up the next poll question for our lender guests out there. Cara, Michelle, what in your opinion, what is the most important factor when you consider which commercial deals to fund?
Well, at Together, we take a very simplistic view, which is why we are seeing customers that, you know, perhaps have been retrenched from mainstream lenders, or they have been turned down from mainstream lenders. But in addition to that, we're actually supporting customers who could go to, you know, your high street offerings, your Lloyds Bank, and so on and so forth. But actually, they're working with us because of our simplistic approach to how we underwrite and how we assess these types of cases. So I guess the key kind of 5 areas that certainly I'd focus on, and Cara can then chip in if there's anything else that she'd look at, but who we're lending to, what the loan purpose is and what the actual security is, income, understanding the income, understanding the exit strategy, and then what's our fallback position if for whatever reason something didn't go to plan, in particular with the exit. And with all those 5 areas, we take a very pragmatic, simplistic approach that if there is a non-standard aspect to that, say for example, if the security perhaps is deemed as a high risk security, pubs for example, the past three now going into our 4th year post-COVID, a lot of other lenders pulled out of that, you know, the hospitality pub market, but actually we've continued to provide finance for those type of securities. Income is another element. Other term lenders in the commercial space will continue to do annual reviews of the performance of the company income. However, with ourselves, it's what the situation is at that time of the underwrite. Thereafter is thereafter, and we'll manage if there's further support that's needed later on. But I think that's kind of the key 5 areas, and it's the simplicity and the common sense underwriting approach that we take within these, which is why we continue to see great levels of lending it together.
Yeah, I would definitely agree with all those 5 factors that we look at it together, you know. So as Michelle said, income, you know, the serviceability is key, the security on offer, is there demand in the local area, the ability to resell the security, the ability to do the overall transaction. And as Michelle was saying, you know, we've got a common sense lending approach together. We're not a computer says no company. We manually underwrite all our cases. You know, we've been lending for 50 years, and that's why we provide so many solutions to clients that have been let down or can't go with a mainstream lender. So it is really important that when you look at the overall client's profile.
I would say what is really good with like lenders like yourself, Cara, is some bridging lenders, like they'll say, like, I obviously understand income is important, but well, some bridging lenders that you'll go to them. So a real good example now with a client where his hotel's not been performing great for the last 2 years, like he refurbed it, and then just with everything that's happened with the cost of living crisis, but rates are starting to come down. So what we're doing is we're putting him on a bridge, we're putting him on it for 18 months, and then it means that in 12 months time his accountant's done projections, everything to show what it's going to look like, because he's put so much, it's 250 grand he's spent on the hotel, so he's like refurbed all the rooms, everything looks like so much better. So obviously it's going to be a lot better the next 12 months. So what we're doing is we're putting him on a bridge, 18 months, allow him the next 12 months performance to be as good as we can, then we'll be able to exit him hopefully to like a tier 1 lender once all that's done. We've got that kind of background information. But I've got some bridging lenders that are like, right, we want to see the last 2 years accounts, even though I'm telling them from day one that the last 2 years accounts aren't great. We're putting them on a retained bridge because we don't have the serviceability there for it at this precise moment. So I understand that there needs to be an element of like a kind of plan B as such, but what is really good with lenders like yourselves is they look at it as like, right, we've got projections, we've got an accountant certificate, we can see that what this is going to look like going forward. But we've got some bridging lenders that are saying, oh no, sorry, I can't do that, even though it's a retained bridge, because the last 2 years' performance hasn't been great. And it's like, yeah, but that's why we're putting them on a bridge, so that by the time they're out of that, they can go exit to a tier 1 lender. So I would say that taking that pragmatic approach on looking at the overall picture of what the future looks like, why we're putting them on a bridge to start with, is really, really important.
Yeah, and I think that's it. I think that's it. And it's looking at the wider picture, particularly with bridging. It's looking sort of and thinking outside the box.
Yeah, many lenders don't like to. Unfortunately, they want to see a very steady exit, you know, and the exit should be the focus, to be fair. You don't want to trap somebody into bridging your bridging rates and the fees and the you know, the default rates that can come at the end of the term. You want to make sure that they can exit, which is the fear. But the stabilization bridge, which you're describing, is crying out for. You know, there's so much crying out for, and even at the end of a development where you've just created, you know, turned something, and I've seen this happen where they've turned something into their business premises, and obviously are just starting out and then can't get out of the bridge. That they need a second bridge effectively, just so they've got some business accounts. Coming from a banking institution last year, you know, the accounts, high street lenders can change their appetite literally from one day to the next, and the drill down on some of these accounts, it depends on, you know, what side of the bed the credit guy got out of that morning to look at it. Oh, I don't like this tiny little piece in this set of accounts because this could lead to this, that, and the other, which is completely unreasonable half the time. But you know, they want more of the vanilla type deals. I have to say, fair play to Together, because you've always taken the attitude that everything turns around at some point. So where some, you know, almost falls into your hands when you get the markets almost pulling out of one particular sector, because you just have the attitude, well, eventually it will turn around. So let's look at the individual basis. I mean, I remember this all the way back to the credit crunch days, when you were pretty much the only lender going throughout that period. And in the second charge industry, you went all the way through and kept a lot of brokers alive back then. Yeah, everything turns around, and you just have to see what the appetite is at that particular time.
Yeah,
and that's
100%.
another thing with that, Michelle, like what Andy said there. So when the examples you give, that is where Together are good, because they will look at the projections, like, and can look at the accountant certificate to see, right, we know the last year's, this year's, well, but the projected net income for the next 12 months is this. So it kind of gives you that halfway house for between, even if it is only going with Together for 2 years or something, at least it's giving you that bit of time until you can hopefully get them onto a tier 1 lender if that's the client's end goal.
Yeah, exactly. I know we're talking about, you know, see, the exit is key for a bridge, but, you know, things don't necessarily go to plan. So the initial part from, I guess, from a broker's perspective is the term long enough that we're looking for a bridge? Does it make sense, especially with delays with planning that we're facing left, right, and centre? But we do have the option that, for example, with that scenario that we've mentioned about, you know, doing development to then change into a business, but then not having sufficient accounts then to term out. That's, again, as a solution that we can offer. We can term out onto a commercial term, again, to give the customer that stepping stone to build their business up, to generate the level of accounts that's needed to then go to either the next step or perhaps a tier 1 lender for the exit strategy. But yeah, we've been going for, as Cara mentioned, it's our 50th year of official trading this year, so we will be celebrating that. But you know, we've been through, not me personally, thankfully, but we've been through a few recessions. I've just faced the one, and that was painful enough. But and I think that just kind of shows that certainty of funding, the fact that we continue to trade throughout 2008, 2009, and offer those solutions when, you know, challenging times, mainstream lenders, their appetite does change like the wind. And that's where you need specialist lenders to come in and kind of fill that gap for customers.
I'm curious, are there any, obviously we've been through a pretty tough time, especially the commercial market over the last like 1 to 2 years. I'm curious, are there any like deal particulars that may have been considered by lenders before, but are absolutely in the no category right now?
I think it's just a mixture. It's just been a more cautious view, where before you could easily raise 75% loan to value, and then all of a sudden it was like, whoa, we're only going to do 50, and it's like, what, hang on a minute, what's going on here? Or it's not a hard no, it's always there, no one's been really sure of what to do or what to bank on, or so it's been quite difficult because there hasn't been like a solid, you cannot do this or you cannot do that. In my experience anyway, I've just found that it's every lender's got a slightly different perception of what's okay and what's not. So it's been quite difficult to place certain things, but I haven't seen a hard no.
Yeah, I would say, see what I found like the other day, like, so 2 banks, for example, so RBS and Atom Bank. So RBS will work on that if, say it's a building and 60% of it is like owner occupied or opco propco, 40% investment, RBS will see that as that's less risk because 60% of that's opco propcos, and they prefer because they can see the accounts. But Atom's the opposite. So Atom, if 60% is commercial investment, the rates are better because they see commercial investment as less risk than opco propco. So it's things like that. Like, as a broker, like, you got to know what every lender, it's not a general rule of thumb like, oh yeah, if you put 60% of that as for your trading business, we're going to get you better rates, because each lender's got different quirks of what they class as less risk. And even now I get a lot of times that people will go to, they've maybe spoke to a residential broker who'll use a sourcing system and say, based on your employment, the property, all this sort of stuff. Oh, I went dark, sorry guys, I need to get Lily back. So based on all these things, I can tell you that I'll get you this loan to value, this rate, all these sort of stuff. But we really can't do that. A lot of times I've got to say to people, like, I can tell you that I'm going to get you between 65 and 75% loan to value. I'm going to get you a rate between 7.5 and like, it's because you've got to take it to tender to see really what's available on the basis of, there is like certain ones that I'll know, especially in Scotland, because we've got less lenders, like that's a together deal all day long. I'll just quote them together rate straight away. But if it is one that's like, I don't know if it might go with Alica or to RBS, for example, and the difference, you are kind of speculating a lot until you actually can speak to the lender to know will they do that. So I would say that that's a bit of a difference from like the resi market on where we're sitting as well.
I think that just reinforces the importance of your role as a broker, because there's every lender in the market has a different opinion on appetites, and that can change throughout the course of a year, sometimes numerous times. And I think that just reinforces the importance of your role as a broker to guide and navigate the customer through to what the right solution is. And it might be the right solution for that time, but it's a solution to perhaps get them onto the ladder, because there's specialist lenders tend to have a greater appetite for entrepreneurials, again, you know, startup businesses, to get them set up, whereas other lenders not so much. So yeah, I think we're certainly lucky to have fantastic relationships with firms that we're obviously working with here on this roundtable today, to continue to raise awareness of what perhaps specialist lenders can do that mainstream lenders can't do. But vice versa, there could be, you know, if there's a better solution, it's what's right for the customer.
Mm-hmm.
Yeah, I mean, there's a hell of a lot of money out there that needs to be lent at the minute. You know, there was a leveling off last year because the interest rates, and I definitely see that that's going to be boosted this year, and we're really going to take off this year. But the only way to do it is either drop your rates or increase risk. There has to be a lot of innovation out there as well. But however, with all innovation, there's a reason why somebody else isn't already doing it. It's because it will be riskier. And there's a fine balance between increasing risk and creating a bubble, the next bubble. And and we don't really want to work towards that. I mean, I have heard on the grapevine that they're proposing 1% deposit mortgages out there now. And so, that risk is definitely increasing and increasing out there. There is, as I say, money that needs to be lent. There is an increasing demand as well.
Mm-hmm. Moving on to the broker perspective, we talked about what a lender might be looking at when considering commercial deals, but equally the broker plays a really important role in this. And I'm very curious to find out what the most important factors to a broker are when choosing which commercial lender to select for your borrower. I've just started a poll question as well for our audience. But Emma, you've pointed out that there's lots of different lenders that have different risk appetites. How do you select the right lender for your customer?
Me personally, I've got a spreadsheet, so I will go down and filter it to Scotland or lending size. For example, I spoke to a client earlier this morning who was borrowing 140,000 in Scotland. Automatically on a commercial investment, I'm down to 2 lenders. So that would kind of narrow it straight away. So I would say that it's really specific. And this is where I think experience is so important. And I would say there's a lot of residential brokers now that will kind of dabble in commercial, but I still think in that you're not really getting, you need somebody that's in about it doing all the deals every day, because, for example, experience is a good one. I've got some lenders that require no experience, but some that require maybe 2 previous flips or 2 background investment properties or something like that. But that's all just knowledge that you build up through time of doing it. And if you're like me that loves spreadsheets, so but that needs change. That spreadsheet needs adapted twice a week at least, because I might have something on it on the Monday, and by the Wednesday a lender's changed their products twice in that time. So you just need to keep on top of that. But I would say that is where knowledge is really, really important, because there isn't a specific what's mainly important across the lenders, because each different lender's got a different priority of what's most important to them. I would say exit is, for a bridge, is obviously really, really important, but I think that one of my notes I put here, that can also be a bit of a challenge as well, because now, for example, with one of the lenders, I'm doing an 18-month bridge for a client that's getting doing a holiday let. So we've put him on an 18-month bridge because he's so convinced that the rates are going to really come down over the next 18 months, or didn't want to commit himself to anything. Gives them at least 12 months to get his trading history. But the lender I'm putting them with, it says that they want a dip, not just a quote, but a full dip on the exit. I'm I can't get a dip for an 18 months time. That's impossible. No term lender's going to give me that. So there's things like that I think is just put in ways as hurdles for us that we because even if I was to get a dip, if I was to waste my time doing a dip for something in 18 months time, it doesn't stand for anything, because that lender could change their criteria next week. So I guess there's got to be an element of what does it look like at the now, but nobody can predict what 18 months looks like.
Yeah, it's a very fine balance between getting the right deal as well as the right relationship, because you can get trapped sometimes into using a particular lender because you know how they work, and you always want to send your client down that route because you know that you can work together and get the deal done. But if you're not still researching the market at the same time, you don't know how off the market rates they may be at that particular time. So you have to kind of balance it out, and the spreadsheet is a great way to start to obviously whittle your criteria down. But then after that, it's, well, okay, let's have a look at what we're left with. Do we know this group? Who is actually giving you the best deal and the best price, and so on, and therefore, can we research? If we haven't used them before and we don't know about their service, can we do a bit of research about them? Is there stuff on LinkedIn where other people have mentioned that particular lender if we never have? As mentioned, there's 250 plus lenders out there. there's no way we've used every single one of them in our time. And every single day I'm coming across a new lender where I've never heard of them before. And I'm like, well, where did they come from, sort of thing, you know, but they're offering on this one. Can we trust them? What is their funding background? And funding background is a bit of a red herring, or, you know, it's the wrong way to go down, because I've worked for both institutionally funded lenders as well as banking lines and so on, and they both have their pros and cons. Quite simply, if they're governed by a funding line, they're governed by their appetite at the time. But conversely, if you're working at a bank, your own appetite can just simply change at that particular time as well. So it doesn't really matter whether it's an institutionally funded lender or it is your own money. The appetite can change overnight either way. And I've seen it in both situations. Yeah, as I say, it's a balance between the relationship and keeping that market research up to date.
One thing that you said there, Andy, that I'll jump in on as well, is a big thing for me is, like, when I do a table to present to my clients to say, right, lenders, here's lender A, B, C, D, and E, for example. This is the rate. So a lot of people in their head think they're driven by rates, but if I've got let's just use 5 high street banks. I know, for example, one of the high street banks will get that completed once it's approved in about 6 weeks maximum, but then I know one of the other lenders will take 6 months. So that comes down to your experience on your lenders and knowing who's going to actually see this through. And one thing that's a big thing for me that I've probably actually more over the last year it's a right, like, bugbear for me, is especially with bridging lenders that will say that they're going to, so you'll speak to the BDM and they'll say, yeah, we'll do this deal, they'll send you terms, they'll tell you all this amazing stuff. The client then pays for the valuation because they've said that they're definitely doing it, and then they come back and they say, oh no, actually there's something that we're not doing it for, that they knew right at the very start, that was already on all the proposals, it was on everything, and they're turning around and say they won't do it. That is where I think I just score them out of my, like, I just put a big red do not use sign on my, because that's just so unfair on the client. And I think if they say that they're going to do it at the start and they're then declining it for something that they already knew, like something that's highlighted, like I had one the other day and it's at the end of the deal that the client needs to know the property that they're buying, but all over my proposal document said it was a bridge for a client to let them draw down money and then they were going to find a property at auction when it comes up. The lender then said, once the client's done absolutely everything right at the very end, we need to see the property the client's buying. I literally put on yellow highlight in my proposal document, the client has not found a property and will not have a property in time for drawdown, and it's still right. And they're lucky enough the client's now found something, but in a scenario like that, they might not have found something, and clients wasting money on broker fees, valuation fees, probably even solicitors fees and everything by that time. I do think that if you're going to say that you're going to do something, that especially as like a BDM, well, bridging BDMs especially, they need the authority to actually know that they're going to do it. If something then comes back in a valuation that isn't out of our control, that's totally fine, but they should never be making a client pay for a valuation and then turn around and decline something that they already knew at the start.
That's poor BDMing. I mean, you can never give the BDM the authority, because obviously that then presents a bit of a conflict with credit, having to get that through. But if you haven't got an experienced BDM that's understood their own appetite more particular, and not be scared to actually discuss with credit before they come back to you. You know, actually be honest and say, look, I think this is one we can do, but I just need to run it through with credit before I can come back to you, rather than just scattergunning, of course we can do this, and be that used car salesman where they just, you know, of yes, all the way down until you're suckered in, and then try and move the goalposts at the end. It's not good. It's not good salesman.
I see, sometimes we see that in the sense, we sometimes see where, you know, there's the fight for the lowest rate, that sometimes ex-bridging lender may, you know, the BDM may, or whomever it was that they spoke with, may go out with what's the lowest rate that they can do. And more often than not, I tend to see inquiries say, can you match this? Can you beat this? Whilst of course we want to support our partners as best as possible from our funding lines, there's obviously there's a flaw that we can go to. But I think with respect to certainly to our team in the BDM team, they know the lending criteria. They've got access to whichever team's members within credit risk. We've got our corporate lending team for the larger loan transactions. Mark Goldberg, if we need to get on the phone to him and speak to something that's way outside of criteria to work through something. So, and often I say, okay, that's fine. You proceed with that bridging lender, because I can't match what they're doing, but this is where we'll be at. And a lot of the time we hear from the dog gets knocking later on down the line to say, actually, you know, that deal that we talked about, could we proceed with you, please? Because they know that we can certainly work with them at speed, as well as providing the level of certainty of the funding. But Cara, have you got anything to add, I guess, from your perspective as a BDM?
Yeah, no, what I was going to say is, you know, you guys absolutely vital, key with the client and the experience, but I think it's also us as a lender is to have that relationship with you guys as well. I think the relationship with the lender is key. I think sometimes us as a lender, we forget how many other lenders that you actually deal with and what sort of criteria you know, God knows how many different lenders changed the rates last year and you guys had to keep up with that. So I think from a relationship manager point of view, it's us educating you on our criteria, educating you on our product changes and keeping you up to date. And I think that relationship with your relationship manager is vital, particularly in the market that we're in at the moment, of keeping you up to speed. But also being honest, I'd rather know all the BDMs that together would rather give you actually, sorry, no, it's not one we can do, or actually we can't do 75%, but we can do 65% at the upfront, rather than you taking you down that journey. You've paid for evaluation, we've wasted yours and your client's time, and then it's going, sorry, actually it's not one for us, or actually 75% is now 50%. I think it's about we look at case by case individually, so it's looking at the whole client's picture and the profile and just being honest at the start.
Yeah, so I agree with everyone, but what Emma said about, obviously you've got your spreadsheet. I mean, I've got similar, some of the colleagues I work with walk past my desk and they're like, what on earth is on your computer screen? It's like, don't worry, it's just the inside of my brain. But it's like there's always been a need for a broker, more so in the commercial space, but last year was really tricky because you do have to know everything, and everything was just changing constantly, whereas before I could kind of rely on, I know that criteria, and you would get a rate change once in a blue moon, or it might be one exciting little bit of thing that you would get on one lender, but they would just almost like, sorry girls, I feel like everyone was kind of like making it up as they go. I'm not together in particular, but all of the lenders were just pulling things left, right and center, making up different loan to values or different criteria, and it was really hard to navigate. But that's obviously why you need good brokers. But I would say, as well as Emma said, so quite a lot of the clients, they'll come to you and they will be very rate conscious. They'll be like, oh, I don't like that rate, or can you get this? And you're like, well, these are the reasons that I advise you to perhaps consider this one that might be more expensive. Like together, there's a different option for, actually this allows you to sort yourself out and then you can go on to this one, or actually you do realize that we can complete in 3 weeks, whereas the other one you'll be waiting 9 months, things like that. So you do have to have, there's lots of different moving parts, but most people automatically assume they're more rate conscious, and actually when it comes to it, they want to do something very strange to the property, or you can advise them that something else might not be as per expected. You can get a very cheap rate, but you're going to wait a while for it.
I even had one the other day, and it was a client that wanted, they kept going about rate, managed to get them a deal that had no early repayment charges, it had unlimited overpayments, the rate was slightly higher, but they could come out of that rate, even though it was a fixed rate, at any time without, and I was like, that lender I know was complete in, like, I would say for a term lender, maybe about 8 to 10 weeks, like, which is obviously quite good compared to some of them. And I was like, look, this is a, like, if you look at it, yes, the rate might be 0.1 0 to more, but I was like, if you actually look at your no early review charge, your unlimited overpayments, your time that you're going to get this completed in, it's actually a much better deal overall. But that's only because, and that's where you get the experience of vouching for lenders. So a lot of lenders will say to me, I'm going to give you a rate of 1.5, but come back to me if you can't get him, and I'll try and lower that for you. And I'm always like, no, give me your best deal. I'll present it. I don't have time to go back and forward to lenders to negotiate deals down. A lot of time for me, I can only vouch for a lender if I've done deals with them and I know they're good and I know they're fast. But even if a lender was a rate of 1% versus 1.2, but I've used the 1.2 lender so much more and I know they're fast, I would be still going with the lender. I would be telling the client, like, I can actually vouch for this lender. I know their process, I know that they're fast, I know that they've got great service, I know, like, things that are all really important to get the deal over the line for the client.
I want to move on towards the bridging market, just to discuss how exactly it's performed and what exactly we might see later down the line, especially considering we've seen a decline in the number of first-time buyers. We've seen property sales fall through during 2023 because of slow progress, chain breaks, and other circumstances. Could these factors and these developments result in an increase in bridging activity this year?
Absolutely. Yeah, it's interesting that point about the drop in, the increase in property sales falling through. A lot of that is down to the buyers just, looking at the interest rates again is the biggest factor last year, and they're expecting a crash. They're almost trying to fuel a crash by going in hardball and trying to get the better deal and not getting it, which is why you've seen, in my view, this dip last year in stuff falling through in more so because this crash that they were predicting hasn't happened, and it's not going to happen because of the lack of stock out there. This lack of stock is always going to keep the prices up. And this year, with the rates starting to come down again, you've got all this opportunity now for all of that stuff that wasn't bought last year will now start to go through, and you've got investors that suddenly realize, okay, we need to change our tact. And I've been at a few property meetings recently, and there is a huge thing about simply adding value to anything they buy rather than just buying as is investment properties. It's all about adding value. And whether it's build or refurb to rent or splitting properties up, as we've talked about earlier, creating HMOs, creating Airbnb type units, all of these things, how do I add value? Hence, I mentioned it earlier, I'm going to get a little plug in again regarding our title split option, where if you've got a multi-unit freehold block, you can actually buy it against the split value before you've actually got the leases in place. But it's adding value by simply putting the leases in place. It's very simple, not even having to do any refurb or actual physical splitting. You're increasing the value by simply putting the leases in place. And this is what they're all looking for. How do we add value this year? And I think you'll see an absolute boom in refurb bridging, commercial to resis, all of that sort of stuff I think is going to absolutely boom this year.
Yeah, I think where you find that there's perhaps a drop in one area, when you mention first-time buyer, the reductions in first-time buyers, actually what that brings is an opportunity in the bridging space, right? Because there's going to be an increase in chain breaks, and that's where bridging finance can offer that, offer the finance that's needed to plug that gap until they've been able to sell the property. Less 5 first-time buyers, potentially an increase in the chain and the duration to get, the whole entire journey completed. And certainly last year, whilst perhaps there may have been some conversion struggles, actually we had 2 record-breaking months for our bridging finance. In April, we completed on 115 million worth of bridging in that month, and that was a record for us. But we broke that record again in November, having completed on 130 million pounds worth of business in bridging in just that 1 month. So we are starting to see more and more of those transactions to purchase property whilst they are going to undertake some refurbishment. And I think that's key, Andy, isn't it? Buying properties where you could do something, whether or not that's to increase the actual asset value or to increase the yield. That's what we will see continued more of in 2024. Certainly conversion of single family lets into HMOs. That's going to be a growing need across the bridging space, but where there are dips in certain areas, there's solutions in other areas and growth in other areas of the business. And a recent research that was conducted the past year, properties that went to auction has risen by 11.3%. What this means, though, is that your standard traditional lenders, your term lenders, might not necessarily be able to move at the pace that's required for an auction transaction. And this is where bridging certainly comes into its own and offers that solution where time is of the essence.
Yeah, so I agree with the first time buyers. Obviously, if they are dwindling in the market, they're the people that are at the bottom of the chain. They're the people that are ready to go. They don't have anything to sell. They don't have just loads of things. So like Michelle said, the chain's going to grow, and the likelihood is someone is going to need some kind of bridging finance at some point, because they're going to sort of say to themselves, well, we're going to lose this property, or we can't do this. And I think maybe the fall at the end of last year was probably down for one but up for the other. So the general kind of population that were thinking about maybe buying a house or doing this have thought, well, things are starting to change, I'm going to hold out, I'm going to see where it goes. And other people were then putting properties on the market and thinking, brilliant, we can go again. And then it goes up and down. So there's always an opportunity where one thing crashes and burns, another one booms. So there's always bits and bobs. But yeah, people obviously, unfortunately, getting repossessed, cost of living crisis, they can't remortgage, or whatever it might be. So auction properties, like you said, Michelle, as well, is you need bridging finance. There's not a lender that I would know in the mortgage industry that could complete in the 28 days. So you need the bridging to buy the auction purchases, unless you're lucky enough to have a load of cash flying around.
So just going to add on the HMO point, it's the boom is actually on high quality HMOs for professionals rather than the student lets type. That's where a lot of focus seems to be going.
And I think that goes back to, sorry, I was just going to say, when we talk about shared living from, the times when people were locked down for such a long length of time, that's, HMO, you're finding more and more individuals actually want other people around them. They want that or need that social environment. So we are seeing that.
Mm-hmm. And I'm just conscious of the time, so before we jump in on the Q&As, and we've got quite a few questions come through, I wanted to ask the panel, do you expect interest rates to drop this year? And if so, how do you expect this to impact funding lines and transactional activity in the bridging market?
Okay. So yeah, it's interesting. Again, I was at Property Meet the other week. It was talking about the interest rates and where they're going to go, highlighting the fact that nearly always the UK interest rates follows the US a month or two later, and they've come out and said that they're not actually going to reduce rates until Q3, more or less. So the prediction from their point of view is the fact that it's going to be more or less the back end of the year before we start seeing the interest rates drop. However, the counter against that is we're likely to have a change of government very soon. and nearly always before a change of government, you'll see the rates drop. So I think this could go against the normal grain, and I think we will start to see earlier rate drops. Either way, I think it's going to drop by 1% by the end of the year. It's going to come down that much. And I know the swap rates are starting to wobble a bit. They have come down, but they have come up a little bit. But I think that's just a natural little wobble on its way down. And you can always be guided by them, to be honest.
Yeah, I think certainly from the bridging perspective as well, in regards to rate reductions, we are kind of predicting around, the May, June time potentially to start to see a reduction in bridging rates across the market. But certainly what you won't see is a like-for-like reduction, that if the Bank of England base rate dropped by, as you say, Andy, 1%, bridging rates won't necessarily be a true reflection on that, because we need to factor in the short nature of bridging finance and the need for the higher margin because of the risks associated with that. So that we're anticipating maybe a 0.10, 0.15% reduction in the market throughout the year at most, really, in the bridging space. But certainly rate reductions will certainly continue to increase encouragement into the bridging market and increase transaction activity.
I think we can actually see the rates coming down as well already. Like even yesterday, I think it was yesterday, like Shawbrook came out that they've reduced their bridging rate down. Don't quote me on it, but I think it was 0.79%, which is excellent. So I've definitely noticed my email's been full of rate reduction. So yeah, I feel like everything that I'm seeing is coming down the way, which is great.
Yeah, it's as more traditional products are utilised, as rates start to decrease, I think that's what will trigger bridging rate decreases as well. I think, like you say, you see more and more, don't you, now at the moment, you get your emails of rate reductions. We did our own rate reductions on term products on Friday, and I think it's only going in the right direction.
Perfect. We've got a couple of questions from the audience. The first one is, what sort of rates are you currently seeing for both bridging, commercial, and development finance?
Right, so that's a bit of a broad spectrum. What maximum, minimum? What are we talking?
I'm not sure. I think just average rates, maybe.
So much variation in that, isn't there? Because it depends on the client, if they've got background assets. It depends on the asset, how it's going to be. If it's a commercial investment, what the strength of the tenants are. If it's a trading business, how strong are the accounts? If it's a development, what's the gross development value? There's literally the variations are insane on where it would be. If I was to if somebody was to say to you, right, you have to pick a figure, I would say an average bridging rate's 1%. Potentially as a proper average. I would say that a commercial mortgage average rate is maybe about 8.9%, and development probably I would say maybe about 11%. I'm literally plucking these numbers out of my head right now, but that's a total average. Natalie and Andy, would you agree with the kind of rates?
I'd say, yeah, bridging and development, you're going to be looking between 10 and 14%, and commercial stuff has dropped down a little bit. I'd say probably between 7 and 9%. So yeah, the sort of ballpark figures you've given there sort of fit into that sort of margin.
Yeah.
And then the second question was, are you seeing lenders offering low rates to entice business, but recouping this through higher fees?
No, I don't think I am.
Yeah, so more on the commercial. So is it where they're sort of lowering the rate, but they're whacking up the high fees?
I'm assuming, yeah.
Yeah, I mean, I'm not sure whether that's sort of recouping it. I think it's being inventive, because a lot of things at the moment, because the rates were very high, people were struggling to either refinance or buy something at the loan to values that they might have otherwise been able to get. So say a rental of £60,000 on whatever kind of property it was, if they could normally get up to 75% because the rates went up so high, there were some people couldn't even get 50%. It was ridiculous at one point. So they've kind of had to be a bit creative where actually over that 5 years, yes, the pricing is exactly the same, but on the rental calculations, it's been able to increase the loan size that they can get to. So yeah, they're still getting the same kind of money for that period of time because of the pricing, but actually they're allowing the customer to refinance or buy at the usual-ish kind of levels that they were
I would
before.
agree with that, and I think that's what you're saying about like being creative with it. Sometimes I'll go to a bridging lender and I'll say to them, like, this client's completely rate focused, like if you can get your rate to below 1%, for example, I think they would go with you. They might charge 0.99%, but put a 2.5% arrangement fee on instead of 2. But that's not them. I genuinely don't think it's them doing it to like be sly or anything. I think it's just, as Natalie said, being creative to what is the client's driver. Is some people are so obsessed with rate that rather than anything else that they see the 0.991% and they're sold. So I think it's about just being creative, but they will, as Natalie said, get the exact same amount of money at the end of it.
It's the interest cover. The interest cover is key there, and you can't reduce your rates just indefinitely without increasing those fees. The lender has to have their return at the end of the day, but it is exactly as Natalie says. It's being creative with that.
Fantastic. That's those are all the questions, and that is pretty much it for this webinar. Thank you so much to everyone who attended, and thank you to all our experts who have shared their insights. I found this to be a very fascinating discussion, if I do say so myself. The full recording will be available on Bridging Commercial in about a week. So if you would like to see this on demand, it will be available on our website. But yes, thank you very much for attending, and hope you all have a wonderful week.
Thank you.
Thank you all.
Thank you, everyone. Okay, bye.